Coming up on the SBS On The Money podcast, the ASX ends its 5-week winning streak, and we take a closer look at two big deals for the market, a possible takeover for Santos, and we preview the Virgin Australia IPO next week. That's all next. Hi everyone, it is Friday, the 20th of June 2025, the Australian share market ending a 5-week winning streak. The S&P ASX 200 down today by 0.2% to 8,505 points. It means for the last 5 trading days, the index is down 0.5%. To tell us more, I spoke with Lochlan Halloway from Morningstar. So, Lochlan, it looks like the ASX 200 has snapped its 5-week winning streak. Obviously, there's a lot of uncertainty out there. What do you ultimately think drove stocks lower this week, and what's changed compared to the past 5?
Look, I mean, uncertainty is the constant companion in financial markets, one week to the next. The story this week, really, for our index was the resources sector. They were the big laggards, and a lot of that comes back to our big iron ore miners, which behind the banks make up the biggest sector on the ASX. There were some very weak numbers from China regarding their steel production. May's usually a very strong month, but this was actually the weakest May in the last 7 years. That raised concerns, understandably, about the outlook for steel production and then, of course, iron ore demand. And there's also obviously concerns lingering about oncoming supply, which is a further downweight to prices. So generally speaking, that caused some trepidation for investors in miners and dragged down the index more broadly.
How much does that have to do with things like the conflict in the Middle East?
Yeah, look, I think they are two separate stories. Both are, generally speaking, not good news for global growth. Obviously, China being the world's second largest economy, particularly for us being such a huge importer, the world's biggest importer of iron ore, that matters. That's one side. The other side, as you mentioned, is the Middle East conflict. And what's really, I suppose, of most concern there is the potential inflationary impacts of high energy prices. We saw oil spike as those escalations began to increase during the week. So that's the other side of things. And obviously, investors are wary of a slowing growth story combined with higher inflation. That is a real challenge for a central bank. And we've seen periods in the past of stagflation. They're not, generally speaking, good times for equity markets. And I think that is the main risk, the main challenge for market sentiment at the moment.
Do you think investors were just looking for an excuse to kind of press the sell button after the market reaching a record high in recent weeks?
Look, it's quite surprising and a little bit puzzling, to be honest, how unperturbed the market has been by many of these lingering global geopolitical risks. I mean, yeah, obviously there was the big sell-off in the early days of April with the Liberation Day announcements, but it rebounded very quickly back to levels that it had been, already extended levels, I might add, at least on our reckoning in terms of where market valuations should sit. We kind of seem to have just brushed that off. And we still have, despite the fact that there are all these concerns now about unresolved issues with the tariffs, this rising conflict in the Middle East, now some concerning production figures from China brought to the fore this week. It's hard to fully understand why the market keeps pushing, say, bellwether stocks like CBA, for example, up to record highs, at least from a fundamentals perspective. We think it's quite hard to square that circle.
When we talk about the other big event that's happened this week across various parts of the world, and that's interest rates. Overnight, the Bank of England held, the Swiss cut to 0%. Norway cut, I think, for the first time in a number of years. And yesterday, the US Federal Reserve left rates on hold. What's the overall direction, though, for global interest rates, especially in the face of US tariffs, and what this will mean for investors?
I think the general direction, if we're going to speak in broad strokes, would be that interest rates are coming down, perhaps not as quickly as we might have expected before the spanner thrown in the works, inflationary spanner thrown in the works by the tariffs, particularly for the US. But generally speaking, markets are still expecting easing this year. In the US, for example, two cuts of price. The challenge, particularly with the US, though, is that they have the inflationary impact of tariffs, because much of that will be passed on to consumers, and there are still a lot of concerns there around where tariffs might settle. We have to remember that even though a lot of those tariffs were suspended, we still have a level of trade restrictiveness in the US that we haven't seen in about a century. So yeah, it's not as bad as it was perhaps on April 2nd, but it's still elevated compared to living memory. So that's one thing. They've got to deal with that, the Federal Reserve. And on the other hand, they've got the growth risk posed by tariffs and the risk to broader global growth. And that would advocate, generally speaking, for lower rates, for monetary easing. So you have this tug of war between higher inflation and lower rates. And that's why the Fed stood pat, and also why, generally speaking, markets have revised fewer the amount of cuts that they're expecting this year. The rest of the world is a little bit different because the direct inflationary impacts are not as clear there, because you're not going to have inflation caused by US tariffs on the rest of the world for the most part. If anything, it might be disinflationary because supply from China might have to be rerouted to other parts of the world. But the growth risk is still there, of course, by this big trade shock. So you'd advocate in general for lower rates across the rest of the world. The US, it's a bit more of a challenge, a bit more confounding.
I'd love to focus on two of what may have been the biggest corporate stories of the week, because they're two areas where you guys have at Morningstar have looked into in detail. Earlier this week, a consortium led by Abu Dhabi National Oil Company made a $30 billion takeover bid for Santos. At the time, it was a 28% premium to its previous close. And the interesting thing too, it's an all-cash offer, right? It's now been a week. What's your take? I guess it's only for...
Look, you're right to point out that that was a 28% premium over the pre-bid share price for Santos, and it was also an all-cash offer. On the surface, you'd say, well, those things are probably attractive, but we still think this bid undervalues Santos as a business. We think that Santos is worth about $10 a share versus this, roughly $8.90 a share bid. ADNOC obviously recognised that this business is undervalued, and that's why they're taking the opportune time now, when valuations across the energy sector are fairly depressed, to try and make a play for Santos. There are still plenty of question marks here now around, Foreign Investment Review Board approval. That's the big pending question mark. And if you look at what the market has implied about the likelihood of this going through, based on where shares are versus the offer price, it looks like they're ascribing only about a 50% chance of this and ultimately closing. And that's our view as well, that this is really a coin toss on whether it's going to go through.
Next week, Virgin Australia returns to the Australian Securities Exchange listing, an offer price of $2.90 per share. How do you think it'll go?
Because anyone's guess where the stock might land on its first day of trade. I mean, who knows with these things? We saw last year a huge surge in the price of Guzman y Gomez shares, for example, with the other marquee float of the year, Digico, ended up being a bit of a fizzer. So we're not, I suppose, in the game of predicting where it might finish on day one, but we do have a long-term price for that business, which is $2.60 a share, which is lower, of course, than the $2.90 a share offer price. So we think that this is being sold for a little bit above fair value. I'd caveat that with, though, it's not a serious premium to what we think the business is worth. And if you are of the view that really favourable conditions for airlines might persist for a bit longer, for example, the competition might stay fairly light for a while longer, you could certainly make the offer price work. We don't think that that's going to persist indefinitely, but you could. So I think the thing with Virgin is that right now Bain's taking the opportunity to cash out when we've seen the exit of Rex and Bonza recently. That's light domestic competition. Generally speaking, capacity is constrained across the airline industry, so it's a good time to be selling into that market, and valuations are relatively elevated across airlines. We don't think it's fair value, and generally speaking, we'd say, look, we don't think the float price is probably fair. Investors might down the road have the opportunity to pick up that business for less.
And finally and quickly, what are you telling your clients at the moment, and do you see any opportunities for investors at the moment?
Yeah, certainly. I'll reiterate the point about the energy sector. Look, Santos might be numbered in terms of its days on the ASX boards, but its peer Woodside is still there and still trading at a depressed valuation. So that is potentially an opportunity there remaining in the energy sector. We still see some consumer defensive names as really attractively priced too. Endeavour, the owner of Dan Murphy's and BWS, that's traded well below our fair value. It has a really rock solid brand. We think it's more of a cyclical story about consumer spending rather than a long-term issue with the brand that's weighing on the price. So we see opportunities there as well.
That's a Lochlan Halloway there from Morningstar. That ends the podcast for the week. Don't forget, if you enjoy it, to give it a like and a review on Apple Podcasts and Spotify, and to click subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.